free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699, or you can request a copy from LegalExchangeShow.com. Once again, 866-848-5699, or you can request it from their website, LegalExchangeShow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Environmental nonprofit Ocean River Institute is working with communities to tackle climate change with nature-based solutions that feature slowing water down and building more soil with grasses and plants. Research indicates that people acting in their own neighborhoods can build an inch of soil in a year and slow sea level rise down by as much as 25%. Please visit oceanriver.org for more information on opportunities to make a difference and go the distance for savvy stewardship of a greener and bluer planet Earth.
If you're looking for an incredible vacation filled with sun, fun, and no need for a passport, look no further than the United States Virgin Islands. St. Croix, St. Thomas, and St. John were voted the #1 vacation destination to visit this December according to U.S. News and World Report. December is the start of the dry season in the islands, so you can expect perfect temperatures, beautiful beaches, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now before Old Man Winter comes calling. Head to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting dav5k.boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
Hope everyone's got all the turkey out of their system. It is Chuck, Mark, and Tucker with you as we kick off the first full week of trading after Thanksgiving. It still is only November 27th because Thanksgiving this year fell on the second earliest day that it possibly could, and so we're still not yet into December. But we've got some early reads on the Black Friday data as far as what people were spending money on, whether they were spending money at all, or whether they were pulling back there. And what I see here, Mark, and this is data from MasterCard Spending Pulse, is that U.S. retail sales up 2.5% from the prior year, which is a modest move up, I think is how I would characterize it. And overall, I think it speaks to one of a couple things. I've seen some other data out there that shows, things a little bit stronger there. But ultimately, I think this is really pointing towards shoppers probably being pretty discerning as far as what they're trying to buy and how they're seeking out deals at this point.
And we care about this. It can get a little tedious every year, agonizing over how much money people are spending on Black Friday. At least I fall into the finding this a little exhausting category. But it is important because consumer spending is a big contributor to GDP, not to long-term growth, which is a totally different thing. But in the short-term, composition of GDP is pretty fixed. It's 70% of GDP consumer spending is, and 20% of that spending, according to the National Retail Federation, happens between November and December. They don't break out Black Friday specifically, but it's for obvious reasons a harbinger. So it is important to the short-term trajectory and health of the economy.
When you look at, and again, here, when we talk about this, there are so many different reports that you get. I saw one on Friday from, I think it was Adobe Analytics, that showed that they saw like high single-digit growth in retail sales across the board on Black Friday. So you get different data out there that shows different things. It is clear that the huge growth we had seen in each of the past 2 years, that's not going to be repeated for a couple reasons. The first being, hey, our household's a little bit more strained right now than they were a year or two ago. The answer is probably by most metrics in the aggregate. Obviously, there can be differences around the margins. But the other piece is shifting habits as far as what people are buying as well, and that we've talked about this, that it hasn't been as retail-focused in the last year, so that growth is tapered off overall. And so this meshes with a lot of the data that we've been seeing about slowing retail sales growth in the last year, even though it picked back up for a couple months in the fall here.
Yeah, and in real terms, in inflation-adjusted terms, if you use the Wall Street Journal's reported number, which is an aggregate, I assume, of in-person and online shopping, you may have already said this, Chuck, the growth rate was 2.5%. Yes, you did say this. That's nominal, I believe. Wall Street Journal cites MasterCard. So, okay, same data source, not a coincidence that that's spot on with your figure. So in inflation-adjusted terms, i.e., in terms of actual stuff bought, it's less than last year. Not by a lot, but by a little.
No, exactly. So there's nothing surprising here to me on this, but the other thing that I often struggle with in trying to figure this out is we understand that Black Friday is a day where, you see all the fights at Walmart over, whatever it is. You see, the idea that, people are, really trying to get out and get those deals purchased then. But the other thing that I struggle with in terms of trying to contextualize this is there's been so much creep in holiday deals and Black Friday deals in that you start seeing them popping up in like October now. I mean, Amazon had a whole Prime Day in October this year. They had two of them. They had one in July and one in October. And so it's tough because we don't see a daily retail sales report, and even if we do, it's not like every retailer reports, hey, here's what we sold every day. They're all estimates, as we talk about quite a lot. And so, yeah, let's say that this was a 2.5% growth in Black Friday sales. Well, if there were just more deals that were pushed forward into October, or maybe people were being more discerning, and so there's going to be, this flurry later on in the year, we don't cover that, and we don't know what's going on a day-by-day basis. So I think that it's tough for me to figure out how much importance to place on this, just because Black Friday is kind of a moving target now. I know that sounds weird to say, but it's not like all the deals actually happen just on Black Friday. You've got these, we got Christmas in July sales going on now. I mean, it's you get what I'm saying?
Yeah, I do, and I feel the same way. It's going to be like with any bit of economic data. You have to keep it in perspective. You can't extrapolate from it. It's dangerous to reason from one bit of information without looking at the whole of the economy. We won't know for months how consumption, that is spending, and GDP shaped up for this quarter. So it's useful, like, again, with any bit of data, to take a longer-term perspective and kind of chill out. Is it good news on the surface? Yeah, the economy doesn't appear to be sliding into a consumer-led recession this quarter, would be one sheen you could put on this data, one interpretation. Beyond that, it's kind of hard to say, at least for me.
Yeah, this fits the narrative and the story of a growth slowdown, but not yet a recession, I think is how I would characterize this. Is that fair?
Yeah, I think, and you've talked a lot about the fact that GDP grew, gross domestic product, which is how it's a very imperfect measure. It is a broad average, but it's the best we got. It grew at more than 2.5 times what most people think is the economy's potential growth rate last quarter, if you annualize the number. And over the past year, it's grown at about 3%. after inflation, which is excellent considering how fast the labor force is growing and how fast productivity is growing. It's above trend, so to speak. So we've been experiencing above trend growth, very fast growth in the third quarter. That's bound to slow. And like you said, this is probably part of that story because consumption is such a big part of overall growth.
When you look at the story for retailers, I know we've been talking in the context of the broader economy, but when we look at what it means for retailers here, it's been a very mixed bag, even quarter to quarter for them, where this quarter, just as an example, we had a couple companies that came out and still, I won't say knocked the cover off the ball, but kind of put to bed some of those worst fears, whereas others, it's been a very volatile couple weeks of trading for retailers where we've 10-15% moves are not unusual in this retail earnings season. And so I do think that there's some added importance to these companies just in terms of their management and their outlook for the next year after what's been a pretty tumultuous year for a number of retailers when we look at it that way.
Yeah, and that tale of two cities is kind of, I've never read the book, I just like the expression.
I've never read it either, actually.
No.
I just know it was the best of times and the worst of times, but I don't know anything other than
Isn't that the opening sentence? It is. It's like saying, call me Ishmael. And that's
exactly.
it. End of the story. That's all I know. I think that's from Moby Dick. But anyway,
it is.
I get all this from movies, so forgive me. Tale of Two Cities in...
Have you ever watched the movie of Tale of Two Cities?
No, I would, but I haven't. Have they made one?
I would be shocked if they haven't.
I'm normally all over that because it's easy education.
They made one in 1935. I'm surprised you haven't seen it.
I was at the opening. I was at the premiere. Sure.
It was starring, let's see, I don't even
somebody with a
recognize
nickname like
names.
Fatty or something from that era.
No, it's just
some
all
demeaning.
No. You would think that. No, we got Ronald Coleman, Elizabeth Allen, Edna Mae Oliver, Reginald Owen. I mean, you don't Basil Rathbone. I mean, these are very 1935 names. Blanche Yerka. Let's see. I'm trying to see if I recognize any names. Lucille Laverne.
H.B. Warner. Tully Marshall.
I'm not seeing a lot of Italians on that list.
No, Mark, we weren't really big in cinema back then. We weren't really big in America back then, let's be honest. But yeah, so sorry, I totally interrupted and don't even know what we were talking about.
No, I was going to say consumer discretionary stocks may be reflecting some of these fitful performance numbers by different retailers. You've got consumer discretionary companies up 22% this year, about the same as the market as a whole. Consumer staples companies are down 4%. They are the odd man out.
Let's take a quick break here just for a couple minutes. When we come back, we'll talk about what we're seeing in terms of credit card debt and whether or not the levels are actually concerning or not. That and more when we return.
Wall Street Watch, a full update on the market's performance to date. Weekdays at 10:30 only here on the Financial Exchange Radio Network. Veterans Development Corporation is a proud partner of the DAV 5K Boston. Let's meet their CEO, Mark Vonner.
I'm no stranger to the military community. My late uncle, Albert Vonner, served proudly in the 1st Marine Division in World War II and gave the ultimate sacrifice for his country. I am surrounded by a family of disabled veterans, including my father, Victor, and brother, Timothy. I am a veteran, and I have dedicated my business and my life to helping veterans. My company, Veterans Development Corporation, works to help disabled veterans every day, and it's one of the key reasons why I'm such a big supporter of Dan Stack and the Disabled American Veterans Department of Massachusetts. I am so thrilled to be proudly partnered with this year's DAV 5K.
Veterans Development Corporation is proudly partnered with the Disabled American Veterans Department of Massachusetts and the presenting sponsor of the DAV 5K Boston. If you'd like to help our great American heroes by making a donation, visit dav5k.boston. Securing your family's financial future is one of the most important elements of estate planning. Leaving assets to your children can be very beneficial. However, gifting these assets can pose major problems. If you gift your home to your kids and they suddenly decide to sell it, your gift could create massive capital gains tax problems. Cushing & Dolan are experts in elder law. Let them help with your legacy planning by calling 866-848-5699. Ask for their new guide called Making the Most of Gifting Assets. Whether you're deep into the planning process or just starting out, this guide contains the information you'll need to make the right decisions for your overall plan. Call today, 866-848-5699, and get this new guide, Making the Most of Gifting Assets. That's 866-848-5699, or request it online at legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and/or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. If you're looking for an incredible vacation filled with sun, fun, and no need for a passport, look no further than the United States Virgin Islands. St. Croix, St. Thomas, and St. John were voted the #1 vacation destination to visit this December according to U.S. News and World Report. December is the start of the dry season in the islands, so you can expect perfect temperatures, beautiful beaches, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now before Old Man Winter comes calling. Head to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Fine-tuning your financial strategy as the year comes to a close is very important. So this month, we're sharing what we believe are the most crucial year-end financial tips. As 2023 winds down, there are several opportunities for you to consider that may help you end this year with as little concern as possible about your overall planning. Things like maximizing your charitable giving, offsetting your capital gains, and contributing as much money as you can to your IRA or 401k plan. We'll walk you through these issues and more in our new free guide called the Top Year-End Financial Tips. Get yours today by calling 800-393-4001. That number again is 800-393-4001, or you can also request the guide online by visiting our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. If you missed any of today's show, catch up whenever you want on our YouTube page. Find daily show segments and full shows. Just go to youtube.com and search for The Financial Exchange. This is your home for breaking business and financial news. This is the Financial Exchange Radio Network.
Piece in the Wall Street Journal: American borrowers are getting closer to maxing out. So, here's what we're seeing right now. If you go back to late 2020, the charge-off rate on credit cards was running about 2%, meaning that card issuers were saying, hey, on average, 2% of what people borrowed from us, they're not going to be able to pay back. As of the most recent data that we have, and this is data from American Express, Capital One, Discover, Synchrony, so big credit card issuers, the net charge-off rate has risen from, again, about 2%, even a little lower than that during the late 2020, early 2021 period, up to 5%. I did the math. That's a 150% increase, which obviously makes everyone be like, oh my goodness, like what's going on? Except that if you look at where credit card balances tended to peak every year prior to the pandemic, they were peaking around, 4.5% to 5% heading into the holiday season usually, and then they get paid down as people get their bonuses and tax refunds and things like that, and then they build back up over the second half of the year. It's kind of like clockwork. So, yes, it is concerning that you do have credit card balances back to where they were pre-pandemic so quickly, I think. But the idea that this is this huge red flag because, credit card charge-offs have increased so quickly, I'm a big proponent of the idea, not that I like it, I guess I'm not a proponent, but I'm a big believer in the idea that if you extend credit to Americans, they will take it. And that's kind of what the American financial system is more or less. So, Mark, I'm not really surprised that, hey, when given the opportunity to have access to credit, Americans have gone after it. And yes, there probably is minimal more room for these charge-offs to increase from here, which leads to one of two possibilities. Either A, which we're already starting to see, is credit card issuers start to pare back on their allowed credit, the credit limits on credit cards because they don't want to get stuck with too large of a default. Or B, Americans continue to plow through and eventually start, defaulting on these in larger numbers. And neither one of those situations is great for the economy, but I'm not at like a 5-alarm fire on this. This is something that is pretty normal behavior, all things considered, in my opinion.
Well, it'll be a problem when the economy slows and unemployment starts to go up. That will happen. The landing might be soft-ish, but there will be some economic pain, I assume, due to Fed rate hikes and the natural ebb and flow of the business cycle. So it'll be a problem for people who are over-leveraged, that is, have borrowed too much relative to a declining income. In the short term, I'm sort of I think I'm with you on this. I view this is ambiguous. It's credit expansion accompanies economic expansions. People feel better about their situation. Businesses finance investment. Consumers finance homes and cars and all the things that are attendant with materially improving lifestyles. So credit expansion is normal. You were talking about something different, an increase in the rate of delinquency and thus writing off of bad loans by big banks. That is a leading indicator, and if that abruptly spiked, it could be a red flashing warning signal. We just need more data and more time, as with a lot of things.
And just we get some data broken down here by the Federal Reserve Bank of Boston as it relates to, hey, what are we seeing in terms of the balances that are being utilized throughout different income levels. And for households that are making the least, under $25,000 in annual income, right now you are seeing like 83% of their balances used every month, which is pretty much where it was in 2019, 2018, 2017, 2016. Like there were 4 years there where you were pretty much right in this range heading into the holiday season. So yes, the balances there have grown since late 2020 when all the stimulus money went in and helped people pay down those balances, but it's kind of returned to a pre-pandemic norm. For those who are making $25,000 to $49,000, you're seeing that balance at about 87%, which is marginally higher than where it was pre-pandemic. You were typically peaking out each year at around 85, so yeah, it's a little bit worse for that demo. Where you see the biggest shifts are the $50,000 to $75,000 income range, which pre-pandemic typically was peaking out most years around a 75% utilization of their credit limit. Now you're seeing that up at like 82, 83. So that to me indicates that either that demo is really feeling the pinch or just has kind of gone and spent more than they normally would have pre-pandemic.
If their limits didn't go up with inflation, then you would expect them to be 20% higher relative to the limit than before the pandemic because prices are 20% higher, right? Assuming all else equal, that spending with cards is proportional to overall spending, that ratio is constant, right? You'd have to increase your limit with inflation for these numbers not to be misleading, or am I missing something?
Well, here's the thing: a lot of issuers will auto adjust your credit limit depending on
really?
kind of how they see things going. I see it on mine at least.
Oh, interesting.
I do see it on mine where I'll get a note, and it'll depend on a number of factors, but I'll get an email. Hey, we've increased your credit limit on this card by X dollars. Well, I didn't ask for it, but okay, it's fine. Or maybe if I've taken out a new loan, hey, you know what? We're decreasing your credit limit by X dollars because you've got a new car loan that you just took out. I've seen it both ways.
That. Okay.
So it may happen, it may not. The other demos, the higher income ones, $75,000 to $99,000. You've seen those balances go from about 70% up to around 75% utilized. And on the 100,000 plus, you've gone from about 60% up to like 67, 68.
Yeah. Okay.
So I still, yes, it probably means something, but then I go back to all of the charts showing household interest payments as a percentage of disposable income. And those are still way below pre-pandemic levels. So it's actually saying that, yes, balances have gone up, but incomes have too, and so that means that they can pay those balances off more easily. So when you try to put the total picture together, I don't know that it conclusively points in either direction. I'm not willing to say, hey, this is all fine, but I'm not really saying this is the end of the world. It just kind of is, for lack of a better way of saying it.
Yeah, again, I'm betting a lot of it is inflation, not having your balances adjusted. I understand some of your cards get adjusted, it sounds like pretty dynamically, but I'm not sure that's the norm. So people are spending more to keep up with price increases and not increasing their credit limits. That would account for the difference. And maybe others are struggling just to keep up and they're charging more.
Let's take a quick break here. When we come back, it's Wall Street Watch, and then we'll talk about the largest delivery business in the United States.
Like us on Facebook and follow us on Twitter @TFE Show. Breaking business news is always first, right here on the Financial Exchange Radio Network. Veterans Development Corporation is a proud partner of the DAV 5K Boston. Let's meet their CEO, Mark Vonner.
I enlisted in the Marine Corps when I was 18 years old, joining a long line of family members who also served our country. After my service, I connected with the VA healthcare systems where I attended meetings with disabled veterans and learned for the first time about the DAV. I was so impressed with the work they do to help millions of veterans, including providing necessary services like transportation, education, and financial opportunities. Today, I stand a proud partner of the DAV and the 2023 DAV 5K. My company, Veterans Development Corporation, is a general contracting firm working with many disabled veterans, and I hope that by sharing my story, many other disabled veterans will be able to reach their goals once they conclude their service.
Veterans Development Corporation is proudly partnered with the Disabled American Veterans Department of Massachusetts and the presenting sponsor of the DAV 5K Boston. If you'd like to help our great American heroes by making a donation, visit dav5k.boston. If you're looking for an incredible vacation filled with sun, fun, and no need for a passport, look no further than the United States Virgin Islands. St. Croix, St. Thomas, and St. John were voted the #1 vacation destination to visit this December according to U.S. News and World Report. December is the start of the dry season in the islands, so you can expect perfect temperatures, beautiful beaches, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now before Old Man Winter comes calling. Head to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Hey, listen, are you a 50-year-old person looking for term life insurance? Then you need to talk to Bob. Bob specializes in helping people find $1 million or more of term life insurance for a couple of $100 a month. Look, you need to know there's a price war in the term life insurance business, and you may be paying too much. Call Bob, and he'll shop and see how much money he can save you. Look, this could be the last term life insurance policy you ever have. Your rates are guaranteed for the next 20 years. That's right, guaranteed level rates for the next 20 years. And if you're a smoker or your health is not perfect, Bob has great rates for you too. So for $1 million of term life insurance coverage for a couple of $100 a month, call Bob right now. 800-965-7987. 800-965-7987. 800-965-7987. That's 800-965-7987. Paid for by Term Direct.
This is Susan and Mike from the Armstrong Advisory Group, and this month we're talking about our free guide, the top year-end financial tips. Mike, the holidays are coming, and that brings with it the desire to gift to your family. What are the rules around the annual gifting limits?
Well, you, Susan, owe me a gift every single year, as we know. But I don't think that's what we're actually talking about. What the rules state is that you're able to make gifts in 2023 up to $17,000 without triggering any sort of reporting or paperwork requirements to the IRS. If you go above that $17,000 exemption amount per person, then you do have to file a gift tax return, but it doesn't necessarily mean that there will be any taxes owed. That's where a tax professional really comes into play here to make sure you understand what the ramifications of that are. But gifts to 529 plans, for instance, if you're looking to fund a specific goal, are very common this time of year.
So if someone's thinking about gifting away as a strategy to reduce their taxable estate, Mike, how do they go about that if they want to give away much more than the $17,000? That's the freebie, if you will.
Honestly, more than we can get to in a quick discussion, but you need to talk to a couple of planners here to make sure you understand the tax ramifications and understand the current limits, because states like Massachusetts just completely redid their estate tax, so there's new things to know about that type of strategy.
Folks, we have information about gifting as well as much more in our brand new guide, The Top Year-End Financial Tips. You can get your copy today by calling 800-393-4001. That's 800-393-4001, or request one online at armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Time now for Wall Street Watch, a complete look at what's moving markets so far today, right here on the Financial Exchange Radio Network.
Well, markets are mostly flat and in mixed territory as traders return from the Thanksgiving holiday and react to consumer spending data on Black Friday and monitor updates on Cyber Monday spending. Albeit shortened, markets last week did manage to notch their fourth straight week in positive territory. At the moment, the Dow is off by 53 points, S&P 500 down by 5 points, and the NASDAQ up by 3 points. Russell 2000 is off by over 1/3% or 7 points. 10-year Treasury yield, that is down by 5 basis points at 4.42%. And crude oil up about 0.25%, trading at $75.69 a barrel. In terms of economic data this week, we'll see the Case-Shiller Home Price Index tomorrow morning, a second estimate of GDP on Wednesday, and the core PCE index on Thursday, the Fed's preferred measure of inflation. Meanwhile, shares in cybersecurity company Okta are down by 3%. After Jefferies downgraded the stock to market perform from outperform, noting the company's security breach in October significantly degraded the brand and led to a lack of trust amongst its customers. Elsewhere, UBS upgraded Teva Pharmaceutical to buy from neutral, citing the pharmaceutical company's strong brand pipeline and upcoming outcomes to 2 major clinical trials. That stock up by 4.5%. UBS also downgraded GE Healthcare Technologies to sell from neutral, saying it expects disappointing margins ahead. That stock down by 4%. And Foot Locker was downgraded to sell from neutral by Citi, noting a tough environment for the shoe and apparel retailers' turnaround. Foot Locker shares currently down by 2%. I'm Tucker Silva, and that's Wall Street Watch.
Mark, do you know who the biggest delivery service now is in the United States?
Well, sure. I read Tucker Silva's stack for today. Otherwise, I would not have guessed.
I was trying
the
to
right
play it
answer.
up, you know.
Oh, sorry. No,
It's
Chuck.
okay.
Is it UPS?
No, Mark, it's not.
Is it FedEx?
It's not FedEx either.
Well, who is it?
It's Amazon. So what we see here is that according to, I don't know whose data this is from, actually. Oh, it looks like the Wall Street Journal just viewed some documents, I guess. So Amazon apparently has already delivered more than 4.8 billion packages, and that's just to the Zodda household. Their internal projections are showing that they're going to deliver somewhere around 5.9 billion packages within the United States by the end of the year. Last year they did 5.2 billion. So,
amazing.
I mean, again, you're talking like 15% package growth rate for Amazon. UPS says that they are unlikely to exceed 5.3 billion package deliveries this year, and in the first 9 months they had 3.4 billion. And FedEx, they had in their previous fiscal year that ended in at the end of May this year, they did around 3.05 billion packages. So Amazon had made it a real mission of theirs over the last 10 years to take over that last mile delivery. And I'll tell you, just based on the vans that I see in my neighborhood and everything, it matches pretty well with the data that you're seeing here as far as who's actually delivering these packages now. It's just remarkable to see. And obviously this is a major factor in the slowing growth of companies like UPS as far as the number of packages that they deliver, just because, look, if Amazon weren't delivering these themselves, they'd probably be going to UPS and the post office most likely, because that's how the spillover from the old UPS contract with Amazon worked, I know.
And they still account, according to this article, for 11% of UPS's revenue. Yep. FedEx, I guess, pulled out entirely. Do you know they have over, as the article points out, so I know you know this, Chuck, but those of you listening may not, they have over 200,000 franchisees driving for them.
Yeah, they've been very good at trying to avoid the unions.
You can do it for as low as, according to the article, $10,000 to start a franchise or to buy a franchise license.
Because basically what Amazon said was, look, we don't want to have a bunch of drivers who unionize. So what do we do? Hey, we're going to let you buy into a local Amazon delivery franchise. You set it up. It's its own business. You can run it. You get the Amazon branding, yada, yada. And guess what? You can't unionize against us because you're not employed by us. And that's how they've been able to grow the way that they have here.
Do they rent the vans, or are they driving their own vehicles? Do you know?
I would
it sounds like you're driving your own, but
I would imagine Amazon probably either rents or leases the vans out to the franchises.
So the people driving the Amazon vans may not be Amazon employees. They may be franchisees. They may be
I would say most likely they're not Amazon employees.
Oh, interesting. Okay, did not know that.
The ones driving the Amazon, like the semi-trucks, I think are, but I can't. If anyone knows, Tucker, what's the text line?
617-3. Oh, sorry. Go ahead.
617-362-1385.
Yeah, if anyone knows about the Amazon semi-truck drivers, I'd be very curious to know kind of what the state of play is there. But I think the vast majority of the vans that you see going around are owned by franchises. Those franchises very well, most likely, do have employees, but not employees of Amazon, employees of the franchise.
Thank you.
Someone asked how many of those Amazon packages are delivered by the United States Postal Service. That's what I want to know.
It used to be a good amount, and I know especially, I remember talking to the post office guys back in 2020 when, again, remember 2020, I mean, everyone was doing their shopping online, and the post office and UPS guys, I'd see them coming by at like 8:30 at night for pretty much all of November and December. And you could tell those guys were just beat. I mean, they were making, a ton in overtime and everything, but those guys were just beat up. I mean, they were doing long shifts every day for about a month and a half straight. So, let's see. Anything else to cover on that? I mean, I just find it fascinating how many there's. 5.9 billion packages a day. I mean, even between the three of them, right? You do the math out, and you're talking 15 billion packages for the year. That means that Americans are having 41 million packages delivered a day to their homes. Which means out of the... No, but it's kind of remarkable, though, in that there are only, Mark, what is it, like 128 million households in the United States?
Don't know off the top of my head, but sounds right.
I think it's like high 120s, maybe low 130s. It pretty much means that 1 out of every 3 households is having a package delivered every day.
I don't wonder
which clicks with what I see.
I really wonder how many of those packages or what percentages those are impulse buys. From people just scrolling through social media and just seeing some ad pop up and they're like, "Oh, I could use that," and then they just buy it right from their phone. That's got to have gone up significantly.
When's the last time you bought something from an ad you saw? Like a pop-up ad or something. Not something... I do them from... Just as an example. This, by the way, was a great deal that I got to tell you about.
Oh.
This morning, the liquor store that I frequent
Mm-hmm.
sent me a Cyber Monday email.
Yep.
Unlimited gift cards, 10% off. Which, again, you think about it, it's basically, hey, I can get 10% off as much of the liquor that I want to buy for the next, like, beer, wine, whatever, for the next year.
Yeah.
I front-loaded a year of booze payments. 10% off.
All right.
So it's free money, right?
There you go.
So I did click on that kind of ad. So I was like,
that's an impulse buy.
Why not? It's 10% cheap. Even if you give me a discount when I go in the store, I've already bought the gift card, so I'm getting an extra 10%.
Yeah.
So that was kind of my thinking.
No, the last time I made an impulse buy, I really don't remember. I'm pretty good about it. I definitely click through to see like what the product is and what kind of deal it is, but I'm pretty hesitant to go forward with that purchase, though. So.
I do a lot of impulse returns. It's only been a few weeks. I'm a Prime member.
But that's an impulse buy.
I lost interest with that. So no, usually it's fairly premeditated and thoughtful, the purchase. I do impulse returns. I haven't touched that in 2 weeks. Sending it back. Is the window open? Bring it back.
I will say with Amazon, the other thing that is nice about the returns now, have you used any of the kiosks at Whole Foods to return stuff?
I haven't yet.
It's actually really good.
So what do? You like scan your palm or something? Or you put it in a box? Or
no, so what you do is you go on your
that?
Amazon app or on the Amazon
seriously?
website. Yeah. You go on and you say, I want to return this, and you say where you click the Whole Foods option.
Okay.
It gives you a label, and then you bring that to the kiosk. You scan it. It gives you a mailing label that you put on it. Pop it in, and you're done. You've got the refund that afternoon.
Wow, that's pretty awesome. I usually just do the whole Kohl's return, but maybe I'll look into that.
So I thought that was pretty impressive. I try to be generally deliberate about things where if I want to buy something that's not like an essential, like if I'm buying deodorant, okay, I'm just going to buy it because I know I need it, right?
Sure. I'd say that's a necessity.
Yeah, thanks for supporting me, Tucker. But if I'm buying anything that's not a necessity, my general rule of thumb is put it in the shopping cart and then wait until tomorrow. And if I still want to buy it tomorrow, I buy it. Otherwise, I don't. Because it gets me out of a lot of impulse buys.
It's a good trick. There you go.
Just, how I try to manage it. Let's take a quick break. And when we come back, talk a little bit about how the White House is trying to tout some supply chains improvement as they try to continue to bring down inflation in 2024.
Text us at 617-362-1385 with your comments and questions about today's show, and let us know what you think about the stories we are covering. This is the Financial Exchange Radio Network.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Fine-tuning your financial strategy as the year comes to a close is very important. So this month, we're sharing what we believe are the most crucial year-end financial tips. As 2023 winds down, there are several opportunities for you to consider that may help you end this year with as little concern as possible about your overall planning. Things like maximizing your charitable giving, offsetting your capital gains, and contributing as much money as you can to your IRA or 401k plan. We'll walk you through these issues and more in our new free guide called the Top Year-End Financial Tips. Get yours today by calling 800-393-4001. That number again is 800-393-4001, or you can also request the guide online by visiting our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. Securing your family's financial future is one of the most important elements of estate planning. Leaving assets to your children can be very beneficial. However, gifting these assets can pose major problems. If you gift your home to your kids and they suddenly decide to sell it, your gift could create massive capital gains tax problems. Cushing & Dolan are experts in elder law. Let them help with your legacy planning by calling 866-848-5699. Ask for their new guide called Making the Most of Gifting Assets. Whether you're deep into the planning process or just starting out, this guide contains the information you'll need to make the right decisions for your overall plan. Call today, 866-848-5699, and get this new guide, Making the Most of Gifting Assets. That's 866-848-5699, or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Veterans Development Corporation is a proud partner of the DAV 5K Boston. Let's meet their CEO, Mark Vonner.
I'm no stranger to the military community. My late uncle, Albert Warner, served proudly in the 1st Marine Division in World War II and gave the ultimate sacrifice for his country. I am surrounded by a family of disabled veterans, including my father, Victor, and brother, Timothy. I am a veteran, and I have dedicated my business and my life to helping veterans. My company, Veterans Development Corporation, works to help disabled veterans every day, and it's one of the key reasons why I'm such a big supporter of Dan Stack and the Disabled American Veterans Department of Massachusetts. I am so thrilled to be proudly partnered with this year's DAV 5K.
Veterans Development Corporation is proudly partnered with the Disabled American Veterans Department of Massachusetts and the presenting sponsor of the DAV 5K Boston. If you'd like to help our great American heroes by making a donation, visit dav5k.boston. If you're looking for an incredible vacation filled with sun, fun, and no need for a passport, look no further than the United States Virgin Islands. St. Croix, St. Thomas, and St. John were voted the #1 vacation destination to visit this December according to U.S. News and World Report. December is the start of the dry season in the islands, so you can expect perfect temperatures, beautiful beaches, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now before Old Man Winter comes calling. Head to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Missed one of our shows? Catch up anytime by asking your Alexa smart speaker to play The Financial Exchange. This is the Financial Exchange Radio Network.
Piece in Bloomberg today, White House touts new supply chain measures as inflation eases. And I don't really know what they're doing, Mark.
Well, it seems that this is directed toward robustness and autonomy in strategically important areas, less about keeping inflationary pressure down, this would be a dubious way to do it. I'm not saying if you expand supply in the face of expanding demand, that doesn't push against inflation pressures. It does in theory. That's never been used effectively to combat high inflation, so I don't think that's what they're trying to do here. My sense, anyway, is that this is more about independence in strategically important areas under the Defense Production Act, unless I'm misreading the thrust of it.
No, I just think that what they're talking about dollar-wise is kind of useless. Like, I'll quote here, "This includes an invocation of the Defense Production Act to invest $35 million in starting materials for sterile injectable medicines." What do you get?
Someone has identified this as a critical link in the medical supply chain, the pharmaceutical supply chain, as they put it here. I know I'm stating the obvious, but some bureaucrat, forgive me, but that's what they are, has selected this as vital, and this is what's problematic about subsidizing certain industries and trying to, at the risk of oversimplifying, pick winners. And I know we talked about this in the past, whether it's semiconductors or other industries that are the technologically vital sector of the day or week or decade. Favoring them with subsidies comes at the expense of other investments potentially. You need taxes to pay for them, or tariffs or something, and that detracts from other areas of the economy inevitably. Hope it works out, but
well, I'm okay with doing it if it's something where you say, look, we're not making enough medicine domestically. Okay, we know this, but that's been because of a hollowing out of medical manufacturing in the United States for the last 30 years. What's the long-term comprehensive plan to fix that? Because this doesn't seem like that. Like this $35 million, that could go in one grant to one company, and then it is just a handout to one company. That's not fixing the problem. What's the comprehensive plan where you say, these are the medicines that we need to make in the U.S. This is how much it's going to cost to do so, and here's the 15-year plan for how we're going to bring that back.
Or just require that, and I wouldn't necessarily favor this, but the blunt way to do it is to require that pharmaceutical companies make stuff here. That would increase prices. Would people be willing to pay that in exchange for the security of supply that comes along with doing everything domestically? What would that mean for prices? A doubling, a tripling of your average medication? I mean, there are that hollowing out, as you described it, coincided with medical inflation. Yeah, it kept things relatively cheaper than that. As obnoxious as medical inflation has been, presumably it would have been higher if companies hadn't been free to select the lowest cost venue for production. So I guess if Americans feel strongly about it, they could send folks to Washington, and I think they have, who want to onshore everything, because it's a slip once you start identifying something as vital. It's a slippery slope. I know we've talked about this before. Why not food? Why not cars? Why not blankets and clothes? And at some point, you're advocating total autarky or producing everything here. I don't know where it stops. This is obviously minimal, this intervention. And because it's minimal, it's hard to see, as you point out, what effect it'll have in aggregate. Probably not much.
If you're looking for an incredible vacation filled with sun, fun, and no need for a passport, look no further than the United States Virgin Islands. St. Croix, St. Thomas, and St. John were voted the #1 vacation destination to visit this December, according to U.S. News and World Report. December is the start of dry season on the island, so you can expect perfect temperatures, beautiful beaches, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now before Old Man Winter comes calling. Head to visitusvi.com, learn about all 3 islands, and plan the ideal vacation for you and your family. America's Caribbean Paradise is waiting for you, so head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Mark, you ever been to a zombie mall?
Yeah, I think I have, actually.
Tell me.
It's a weird experience because it's anchor stores, which you enter from the front now, like Lincoln Mall in Lincoln, Rhode Island is a good example. In the 80s and 90s, it epitomized mall culture. You had an arcade, you had a theater. People of a certain age know what I'm talking about. You had Hickory Farms, you had the Roast House. These are like generic names that you would have seen, I think, in Natick. Sure. This is pre-South Shore Plaza. I don't know. Was there a mall there before the plaza? I don't know. But anyway, those of us who grew up with malls know what it was like in the golden age of malls. And to see them now anchored by stores that you can only enter from the outside, sometimes connected by these long corridors that used to be thriving store front and passageways and stuff. It's a weird experience.
And what we see here is that the reason why, if you see these, again, mostly empty, dilapidated malls that are there, that might be, a quarter occupied or half occupied, the reason why they tend to stay that way is because the developers that own those malls want to get something for their money. Like they want some kind of return. They're not getting, any revenue really. And so they say, yeah, we're looking for someone to come in and make us, a huge offer to put up, condos and tear this thing down so that we can get something on the exit. And that's why these places end up just existing for, 5, 6, 7 years, where you're like, how is that place still there, even though it's been empty for a decade? It's because the owner's not really paying much on it at this point. Like, there's not much for them to pay. They probably already defaulted, on the loan or had it paid off. And they're like, okay, like, no one wants this. The bank gave it back to us because they can't do anything with it.
What do you do?
And so it just ends up sitting there until the company finally says, let's sell it. Quick break here. Hour 2 of the Financial Exchange is up next.
This is Tucker Silva of the Financial Exchange, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. And today we're talking about the implications of gifting your assets away. Todd, what happens if you give your home to your child in an effort to protect it from the nursing home, and later on you decide you want to sell it?
Yeah, that's just one of the problems of giving away your house, but let's explore it. If you give your house to your child thinking, okay, that was easy, but now you don't own it. So now you really have no right to live there and, of course, no right to sell it. Right now, if you happen to have kids that are really nice and you ask their permission, which I don't ever want my clients to have to do, to say, please sell the house, you've also given them a huge tax liability because all the proceeds would go to them. Now, you don't have the money you need to buy your new house. And plus, if they don't live with you, then they don't get this capital gains exclusion that goes around along with selling your primary residence. So you're creating an adverse capital gains tax bill for them to pay. And then in addition to that, if they are nice, after they pay the tax, then they have to give you the money back, which could create a gift tax problem for them and impact their estate planning efforts. Finally, you get the money back, and then you can go ahead and buy another house. Folks, don't go through that. Set up an irrevocable trust to protect your assets from the cost of long-term care.
Educate yourself about the implications of gifting your assets away. Request your free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699. That's 866-848-5699. Or you can request a copy from their website, legalexchangeshow.com.
The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated.
Are you retired like me, and you just found out you owe the IRS a ton of money? Well, what would your life be like if they took your retirement savings away from you? They can do it, and your property. If you owe the IRS back taxes or you haven't filed in a while, the Tax Relief Line is here to help you. They can stop the IRS from taking your retirement savings. If you qualify, you could have your tax bill reduced to zero. That's right, if you're retired and you owe the IRS a lot in back taxes, you could have your entire tax bill reduced to zero due. The IRS has now hired thousands of new employees, so they're ready to come after you. Don't let them take your retirement savings or property. Make this free call now.
800-251-2153. 800-251-2153. 800-251-2153. That's 800-251-2153.
This is the Money Matters Radio Network. WBNW 1120 AM and W275CM FM. Concord, Boston. The Money Matters Radio Network. If you're looking for an incredible vacation filled with sun, fun, and no need for a passport, look no further than the United States Virgin Islands. St. Croix, St. Thomas, and St. John were voted the #1 vacation destination to visit this December according to U.S. News and World Report. December is the start of the dry season in the islands, so you can expect perfect temperatures, beautiful beaches, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now before Old Man Winter comes calling. Head to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Finding great candidates to hire can be like, well, trying to find a needle in a haystack, but not with ZipRecruiter. Its powerful technology actively finds and invites qualified candidates to apply to your job. So while other companies might deliver a lot of hay, ZipRecruiter finds you the needle in the haystack.
See why 4 out of 5 employers who post a job on ZipRecruiter get a quality candidate within the first day. Try ZipRecruiter for free at ZipRecruiter.com/free. That's ZipRecruiter.com/free.
At Consumer Cellular, you get the same exact coverage as the largest carriers, but for up to half the cost. Same thing, up to half the cost. Up to half the cost for the same thing. 50% the money for 100% the same thing. I hope I'm making myself clear. Consumer Cellular. When freedom calls, we're here to answer. Call us at 1-888-FREEDOM.
Half the cost savings based on cost of Consumer Cellular single-line 5GB data plan with unlimited talk and text compared to lowest cost single-line postpaid unlimited talk, text, and data plan offered by T-Mobile and Verizon May 2023.
Legacy planning is incredibly important if you want to make sure you keep your assets in your family. But if it isn't done properly, you can create significant problems. Gifting assets to your children is admirable, but may not always be the best course of action, especially if there are financial difficulties or a divorce proceeding. Learn how to protect yourself and your family by calling Cushing & Dolan and asking for their brand new guide called Making the Most of Gifting Assets. In it, you'll learn about information related to the gifting process, what tax issues may arise from a major gift like a home or a vacation property, and what happens to the asset if a child has creditor issues. Call 866-848-5699. That's 866-848-5699. Or request it online from their website, legalexchangeshow.com. The proceeding was paid for, and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
For 40 years, Cancer Support Community has been a relentless ally for anyone impacted by cancer, with free services provided online and in person, with their newest location in Massachusetts. Connect with Cancer Support Community Massachusetts for free emotional support, educational resources, patient navigation, financial counseling, and more. 617-797-3391. CancerSupportMass.org. CancerSupportMass.org.
It happens all over Massachusetts.
Can you tie my shoes?
In every home and every community.
Be careful on your bike.
Learning can happen anytime, anywhere.
We'll see you at practice this weekend.
And no matter how learning takes place in your family's life, DESE is there as your partner. The Massachusetts Department of Elementary and Secondary Education. Never stop learning. Find out more at mass.gov/back-to-school.
Sponsored by the Massachusetts Department for Elementary and Secondary Education.
Hi, this is Mike Armstrong from the Armstrong Advisory Group. Fine-tuning your financial strategy as the year comes to a close is very important. So this month, we're sharing what we believe are the most crucial year-end financial tips. As 2023 winds down, there are several opportunities for you to consider that may help you end this year with as little concern as possible about your overall planning. Things like maximizing your charitable giving, offsetting your capital gains, and contributing as much money as you can to your IRA or 401k plan. We'll walk you through these issues and more in our new free guide called the Top Year-End Financial Tips. Get yours today by calling 800-393-4001. That number again is 800-393-4001, or you can also request the guide online by visiting our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The Financial Exchange is produced by Money Matters Radio and is hosted by employees of the Armstrong Advisory Group, a registered investment advisor that provides investment advisory services. All opinions expressed are solely those of the hosts, do not reflect the opinions of Armstrong Advisory or anyone else, and do not guarantee profit. Investments can lose money. This program does not offer any specific financial or investment advice. Please consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong and Money Matters Radio do not compensate each other for referrals and are not affiliated. This is the Financial Exchange with Chuck Zodda and Marc Fandetti. Your exclusive look at business and financial news affecting your day, your city, your world. Stay informed and up to date about economic and market trends, plus breaking business news every day. The Financial Exchange is a proud partner of the Disabled American Veterans Department of Massachusetts. Help us support our great American heroes by visiting DAV5K.Boston and making a donation today. The DAV 5K Boston is presented by Veterans Development Corporation. This is the Financial Exchange with Chuck Zodda and Marc Fandetti.
A little bit after 11 a.m. here, and we've got markets just drifting downward a little bit. The Dow's off 70 points, the S&P's off 10, Nasdaq's off 13, so anywhere from 0.1% to 0.25% downward drift in markets. 10-year U.S. Treasury is down 5 basis points to 4.43%. By the way, that has dragged mortgage rates down to 7.32% nationally, according to Mortgage News Daily. down from over 8% back in late October. We've got oil, West Texas Intermediate, down 3 cents a barrel. Yahoo, 75.51 a barrel is where that's trading right now. And the AAA National Gas Price Average, or the Gavrage, if you will, is now at $3.25, down another half cent overnight, and about 60 cents lower than we were at just before Halloween. We've also got gold on the move today. Not a huge move, up $6.70 an ounce, but back above $2,000 an ounce, $2,009.70. And that's what we've got moving in major markets today. It's Chuck, Mark, and Tucker with you. And piece in the Wall Street Journal, investors see interest rates coming soon, recession or not. Your thoughts, Mark?
I'm confused. Why would the Fed cut rates if the economy was still chugging along, more or less at its potential growth rate? I think it's useful to keep in mind what the Fed does, how it does it, what it responds to, what kind of rule it follows. It doesn't slavishly follow a rule, but it does look at the gap between what the economy is producing and what its potential to produce is. If you like, the difference between supply and demand, supply being a long-term thing determined by structural factors, demand fluctuating a lot and causing recessions. At least that's the way current researchers look at the relationship between supply and demand. So if the economy's chugging along at trend or better growth, reasonably solid given what its potential is. If inflation is down a lot over the past year, but core inflation remains elevated relative to its target. Now, you could let it sit where it is probably without disrupting people's lives in a major way. I'm not saying the inflation of the past 3 years hasn't been disruptive. Clearly, a lot of people are very upset about it, myself included, because it was probably avoidable. But core inflation remains elevated, though it's improved year over year. Why in the world would the Fed cut rates? And the answer, I'm not going to answer the question, Chuck. I'll let you answer the question because it's kind of rhetorical. But this is asset managers planting ideas in the heads of reporters who dutifully parrot the line. Asset managers love rate cuts. Bonds go up, stocks go up. They get their big year-end bonuses. Unclear from a macroeconomic perspective why the Fed would cut rates absent a slowdown or recession.
Yeah, I've got a few things that I want to talk about on this. The first question that I have for you, Mark, is not question, but I guess my statement that gets right at what you're talking about. We're at the point in a business cycle right now where the discussion about potential rate cuts could still be viewed as beneficial to an economy and to the market. Because, hey, the economy's slowing but not in recession. Hey, if interest rates just came down a little bit, maybe that would, help to just keep things afloat, right? Like that's the thinking that is being portrayed here, at least.
In the last 30 years, it's happened a couple times. In '98, the U.S. economy wasn't obviously in trouble, but international events precipitated rapid easing. And again in 2007, the economy was in trouble. It wasn't showing up in the numbers yet, but anecdotally, the evidence was pretty clear. The Fed cut in anticipation of economic problems. Those are the only two episodes that come to mind for me of a preemptive rate cut, usually in response to something that hadn't, the ripple effects of which hadn't either reached our shores yet, or in the case of 2007, hadn't shown up in the data yet.
Let me ask you this, because I've seen bandied about this idea that let's play things out 6 months from now, and we're in May of 2024. And let's say we've got inflation down, running, mid to high twos somewhere. Again, I'm not saying this is where it will be, but this is the case that I've seen. So inflation is, it's got a 2 in the first digit. Okay, that's great. And we start seeing signs that the economy is approaching stall speed. It's not necessarily in recession yet, but maybe GDP growth is trending towards, the 0.5% to 1% range. I've seen it talked about, hey, what if the Fed just did, a couple of 0.25% cuts, got the Fed funds rate down to, 4.75 or something like that. Mortgages can come down a little bit, and that kind of gives you your soft landing. Is that something that is realistic, or is that just pure, magical thinking?
Let's keep the Fed's dual mandate in mind. They are required by law since the 1970s to keep an eye on inflation, to keep it low and stable. and unemployment. There's actually an interest rate mandate in there, but it's implied by the first two. So anyway, looking at those two things in the scenario you just posited, if unemployment is, say, going up, maybe actually, yes, if inflation is under control, so you can check the box on the first part of their mandate, and unemployment is creeping up, I would expect them to cut, yeah.
I guess let me ask you this. In that scenario, do just a couple of rate cuts do anything, or does it have to be something larger?
Great question. Depends on what you think about how monetary policy works. If it's signaling a willingness to ease further, people believe that, maybe push up asset prices, and then through wealth effects, asset prices contribute to consumption and thus growth. That could do the job, or they may need to do more. It depends, I think, on the context, overall conditions, and how and what channels through which they're trying to get monetary policy to work. It's complicated.
Let's take a quick break here. When we come back, I want to talk about the amount that's sitting in money market mutual funds right now. It's being talked about an awful lot. I'm seeing a lot of chatter about it, so I want to talk about what it does mean, what it doesn't mean, and where things go from here on that front when we come back. We've also got trivia coming up next on the Financial Exchange.
This is your home for the most comprehensive coverage of the economy and the trends on Wall Street. This is the Financial Exchange Radio Network. If you're looking for an incredible vacation filled with sun, fun, and no need for a passport, look no further than the United States Virgin Islands. St. Croix, St. Thomas, and St. John were voted the #1 vacation destination to visit this December according to U.S. News and World Report. December is the start of the dry season in the islands, so you can expect perfect temperatures, beautiful beaches, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now before Old Man Winter comes calling. Head to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Securing your family's financial future is one of the most important elements of estate planning. Leaving assets to your children can be very beneficial. However, gifting these assets can pose major problems. If you gift your home to your kids and they suddenly decide to sell it, your gift could create massive capital gains tax problems. Cushing & Dolan are experts in elder law. Let them help with your legacy planning by calling 866-848-5699. Ask for their new guide called Making the Most of Gifting Assets. Whether you're deep into the planning process or just starting out, this guide contains the information you'll need to make the right decisions for your overall plan. Call today, 866-848-5699, and get this new guide, Making the Most of Gifting Assets. That's 866-848-5699, or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated.
Hi folks, it's Susan and Mike from the Armstrong Advisory Group to talk with you today about our top year-end planning tips, which are featured in our brand new guide for the month of November. There's a lot of information in this guide, Mike, that we can certainly use throughout the course of the year, but some of the tips that we've included, if you don't implement them before year-end, it's too late. What are those?
Yeah, so a lot of them have to do with retirement accounts. So, for instance, if you have a required minimum distribution, that's a 12/31 due date, and most of the custodians actually require you to do it earlier than that, so get on it if you have an RMD. If you're considering a Roth conversion, that also needs to be done by December 31st. You can't do it until your tax filing deadline. And 401k contributions, once again, must be in to your employer-sponsored plan before year-end. You have a little bit more flexibility if you have an IRA, but with some of those things, it's by year-end, not the tax filing deadline. There's also a big one to keep track of this time of year that a lot of people look into, and that has to do with harvesting potential losses. And given the way that markets have fluctuated this year, it very well could be that you have some capital losses in an investment portfolio, and at least looking at those and seeing how they could benefit you from a tax perspective is important. Obviously, caveat, speak with a tax professional or advisor when looking at this type of thing.
Great. Thanks, Mike. Folks, you can request your free copy of this brand new guide by calling 800-393-4001. That's 800-393-4001. You can also request your free copy of our top year-end planning tips guide by visiting our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. The latest news on inflation and how the markets are reacting every morning, right here on the Financial Exchange Radio Network.
Time for trivia here on the Financial Exchange, and it's brought to you by Applebee's. Choose from a variety of half-price late-night appetizers after 9 p.m., including half-price boneless buffalo wings, half-price spinach and artichoke dip, and half-price warm pretzels dipped in beer cheese. Gather with friends any day of the week at Applebee's and say hello to half-price appetizers served late night, because half off is just more fun. Now, that's eating good in the neighborhood. Void where prohibited. Dine in only. Well, before Black Friday became an online shopping experience, it was a day when millions of Americans would pack into their local mall. America fell in love with shopping malls in the 1950s when they started popping up in towns across the country. Massachusetts was home to the first two-story mall in the country. Trivia question today. What is the oldest mall in Massachusetts? Once again, what is the oldest mall in Massachusetts? Be the seventh person today to text us at 617-362-1385 with the correct answer. And you win a Financial Exchange Show t-shirt and be registered to win a $100 gift card to Applebee's. Be sure to include the keyword Applebee's in your text, and we'll give away that Applebee's gift card on Friday's show. 617-362-1385, and the seventh correct response will be our winner. See complete contest rules at financialexchangeshow.com.
Mark, I got a few bones to pick with this piece in the Wall Street Journal titled, "Investors Are Hungry for Risk and Holding Record Cash Sums."
You and me both.
Oh, good. I can't wait. I love when we get like this on pieces
Tag
like this.
team.
Oh, this is the
Some
best.
hapless 28-year-old journalist.
First thing, I'll start right with the title. Money market funds are not cash. We learned this in 2008, right?
Yes, we did.
They're not cash. They're not FDIC insured. They are not cash. Like they're cash-like instruments, but they're not cash. So this is something that always bothers me when people talk about money market funds, just because, and you've noted this a number of times, that there is risk in a money market fund that does not exist in a bank account. Correct?
Yeah, they're more like bank accounts than they are like cash. But like with many investments, you've got to ask what's under the hood, know what you're owning. Is there credit risk, or is there just interest rate risk? In the case of a money market fund, there's really not the latter. But yeah, you have to know what you're owning, like with anything.
Second piece here is that we, according to data from the Investment Company Institute, ICI, we have seen money market fund balances balloon to more than $5.73 trillion. If you go back just about a little more than a year ago, like late September, you were at $4.59 trillion. So you've seen money market fund assets grow by like $1.1 trillion plus in about 14 months. So when we talk about this, I think the first thing is there's an assumption built into this piece that talks about, well, this money's moved from stocks into money market funds, and I'm not sure that that's necessarily the case to begin with. I think that you could very well have seen a lot of this come from bond funds that have gotten hammered in the last couple of years as rates have risen, and this might not be money that's looking to go back into risk assets when it's all said and done. It might be just looking to be in something that is less volatile than other parts of the bond market. Is that a fair statement?
Yeah, yes, absolutely. Also, you've got deposits at all commercial banks. I'll just use the top line number reported by the Federal Reserve, down about $1 trillion from the March bank turmoil episode. Presumably that moved into something that people consider to be nearly money good, which would be money market funds, though they're not, as you point out, FDIC insured. It would take extreme economic trauma to impair the worth of the value of a money market fund. It's happened. It happened in 2008, as we all remember. But so presumably some of these outflows, nearly $1 trillion, went to money market funds as well.
So these are some of the things that I have problems with. I'll let you get a couple off your chest.
Well, I guess the biggest thing, this you're going to find this a little bit odd of all the things to take issue with. But the idea that as soon as short-term rates start coming down, says one equity manager, who, i.e. stock manager, who wants you to buy stocks. As soon as short-term rates coming down, as their take, start coming down, they assert these assets will start to flow out of money market and into equities. And I'm thinking, why would, if the Fed is lowering rates because there's economic trouble on the horizon, why in the world would somebody pile into a growth-sensitive risk asset? It'll be the opposite. Presumably there'll be maybe bonds in a flight to safety. In fact, that's likely what would happen. But equities, just an example of how you can't trust people from the asset management industry to be objective when it comes to, I don't know, why is my voice cracking? I'm getting so worked up over this. You can't trust them to dispense objective asset allocation advice. They're incapable of it. And that's just economically incoherent.
And as you mentioned, a lot of the banks earlier this year, remember around the Silicon Valley Bank blow up, were saying, hey, we're losing deposits left and right to money market fund accounts. Like that's where the money's going. Like we're losing them out of the banking system because our deposit rates are much lower than what people are earning on these money market funds. And so it dovetails nicely there where, hey, if rates start coming down, and this was money that was originally in a bank account, just as an example, is this money all of a sudden going to flock to equities if it was just sitting in a bank to begin with?
Look, it might look for higher yield alternatives, which is why people should regularly look at CD rates. Now, we can't be expected to be interest rate forecasters. I try to do a lot of forecasting. I'm not any good at it because these things are largely randomly determined. But you need to think about, well, if rates are going to be coming down over the next year, suppose your view is that the economy is going to slow. Rates will probably come down, assuming inflation is under control. I know there's a lot of qualifications being layered on there, but suppose that happens. Then a CD today is a better deal because you're locking in a rate than a money market fund whose yield will change, or certainly than a savings account. If you're in a 401k plan, some stable value funds, which look like money market funds, but they're not. Sometimes they're even marketed under the principal preservation moniker, but technically they're different than money market funds. But they can offer higher rates for a longer period of time because they reset periodically, sometimes only once or twice a year. So stable value fund or guaranteed investment or insurance contract type investments in a retirement plan might offer you the opportunity to lock in what could be cyclically high rates if the Fed does have to cut in response to a slowing economy, Chuck. So like with anything, revisit your investments as your economic outlook changes and make sure that if you think yields have peaked, that you're locked into something that will secure those yields for as long as possible, I guess.
I got a personal question for you now, Mark.
Go ahead.
On a scale from 1 to 10, how unhappy are you talking to me right now?
Unhappy?
Yeah. 10
not,
being I'm very unhappy, 1 being I'm very happy.
I love this subject, so I'm very happy. 1.
So you're a 1.
This is this is great. Most fun I've had in at least a week.
I bring this up because the next piece from the Wall Street Journal is titled, "Why is everyone so unhappy at work right now?" And so I'm glad to hear that you're not everyone. And what's interesting is, so there's again, you've got a couple different surveys out here, one from Gallup and one from a company called Bamboo HR, who I don't know, I'm not familiar with them, but I guess they do HR with panda bears or something. I don't know. But these surveys are showing that U.S. workers are angry, they are unsatisfied with their jobs, they're stressed, they're disengaged, and I'm trying to figure out, Mark, is this a workplace problem, or is this a society in 2023 problem? And I'm leaning closer to the second option than the first one?
I don't put too much stock in these surveys. The results tend to be all over the place. It's hard to compare them over time because you're surveying different groups in different circumstances. So I'm just going to plead ignorance, Chuck. I never know how to interpret these numbers. You might be right. There might be this simmering discontent generally.
Well, I think that I'm a big fan of wherever you go, there you are, in that it doesn't matter what you're doing. You generally bring your problems with you. Like, if you were unhappy with your previous job, you're probably going to be unhappy with your new one. If you were unhappy with your previous spouse, you're probably going to be unhappy with your new one. It's just these things tend to be more internal than external in a lot of cases, and how we internalize kind of the external world. And where I'm going with this is that I don't know that Americans are inherently like less happy with their jobs today than they are, but I know they're less happy with their lives, and that probably materializes in their jobs being reflected poorly, I think.
Look, there are genuinely, objectively, indisputably bad jobs and marriages and relationships,
of course
right?
There are. Yes,
so, I mean,
I
know a lot of
that.
people like you. No, I know. I'm not saying that you were. I'm just acknowledging that in case anybody who doesn't know you like Tucker and I do misinterpreted what you said. We acknowledge that. So there are times when it makes sense to blow up your situation. Stuff like this, I don't know. You ask people right before they're about to incur massive credit card bills and spend time with a lot of people maybe they'd not choose to spend time with voluntarily, i.e. Family. Not my case, but some people don't like hanging out with their family. They got to take vacation time to do it in some instances because they got to travel. There are lots of reasons to be crabby this time of year. Maybe this is the vehicle for expressing that. I don't know.
Yeah, I think the last 3 years have just been really hard. Like, it's been one thing after another, and I think we're all just a little beat up. And I don't know that it's necessarily just about the job. I want to talk more about this. Quick break, trivia answer, more about job satisfaction when we return.
Bringing the latest financial news straight to your radio every day. It's the Financial Exchange on the Financial Exchange Radio Network.
We are the Debt Destroyer Network. Any debt you have, credit card, tax, student loan debt, call now for free information that helps you destroy your debt. It's great advice. Plus, when you make this free call now, we have Debt Destroyer experts ready to help. They can show you how to destroy your debt and get your life back on track. Debt problems don't have to be overwhelming. You can live stress-free and debt-free. Credit cards, medical bills, IRS tax problems, even student loan debt. Learn about free programs offered by the credit card companies, hospitals, and even the government that can help slash your debt. Call the Debt Destroyer now for free information. Call now. 800-430-8804. 800-430-8804. 800-430-8804. Again, that's 800-430-8804.
If you're looking for an incredible vacation filled with sun, fun, and no need for a passport, look no further than the United States Virgin Islands. St. Croix, St. Thomas, and St. John were voted the #1 vacation destination to visit this December according to U.S. News and World Report. December is the start of the dry season in the islands, so you can expect perfect temperatures, beautiful beaches, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now before Old Man Winter comes calling. Head to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com.
Building a solid financial strategy is a core element to enjoying your retirement years. That's why you need advice that you can count on. At the Armstrong Advisory Group, we understand the challenges of positioning your assets to help you maintain your wealth over time. Our goal is to offer advice that is both suitable and in your best interest. When you hire one of us, you hire all of us so you can be comfortable knowing that every advisor in our firm is dedicated to helping you create a realistic plan for your later years. Visit us today at armstrongadvisory.com and sign up for a free, no-obligation planning session. Click the Get Started button at the top right corner of the homepage, and you can select the day and time that works best for you. Go to armstrongadvisory.com and let us help you secure your financial future. That's armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services.
This is Tucker Silva of the Financial Exchange, and I'm joined today by estate planning attorney Todd Lutzke, a partner with the law firm of Cushing & Dolan with a master's in taxation. And today, we're talking about the implications of gifting assets away. Todd, if you're trying to protect your assets from the cost of long-term care expenses, what are the risks in giving your assets to a child rather than transferring them to an irrevocable trust?
Yeah, that's a great question. So many people feel like, oh my gosh, it's an irrevocable trust. I've lost all control. I've given up the ability to do just about anything. You know, you hear that all the time. But you know what? Think about it. If I instead gave my investment portfolio to my children, right, or my rental property to my children, I mean, how much control do I have over that? I got none. I mean, I got to rely on them to pretty much do everything, not to mention the fact that, you know, let's say I gave my rental property away. Technically, I can't sell it. I can't do anything without the children doing it. And what you forget is the children then would be entitled to all the rent. Well, you gave away your rental income. You know, what about if a child gets a divorce and you gave them an investment portfolio to hold on to? Well, that money would all be subject to their divorce or any of their creditors. Plus, it all gets picked up on their income tax return. Folks, you give away assets, you lose all control and create lots of adverse income tax and gift tax consequences. You're way better off setting up an irrevocable trust to protect your assets from the cost of long-term care.
Educate yourself about the implications of gifting your assets away. Request your free copy of Todd's brand new guide called Making the Most of Gifting Assets right now by calling 866-848-5699, or you can request a copy from LegalExchangeShow.com. Once again, 866-848-5699, or you can request it from their website, LegalExchangeShow.com.
The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing and Armstrong do not endorse each other and are not affiliated. For your chance to win our daily trivia contest, text us at 617-362-1385. Complete rules are available at financialexchangeshow.com. This is the Financial Exchange Radio Network.
All right, trivia question today was, what is the oldest mall in Massachusetts? Well, that would be Shoppers World in Framingham, one of the earliest suburban shopping malls in the U.S. Shoppers World opened on October 4th, 1951, with 44 stores, 25,000 people, and State Treasurer John Hurley present. This futuristic concept mall was designed to be the mecca of suburban shopping between Boston and Worcester, as the area around its original property remains today. Winner of the Financial Exchange Show t-shirt was Elizabeth from Kittery, Maine. And Elizabeth's also registered to win a $100 gift card to Applebee's, which we'll give away on Friday's show. And trivia is brought to you by Applebee's. Choose from a variety of half-price late-night appetizers after 9 p.m. because half off is just more fun. Now, that's eating good in the neighborhood. Void where prohibited. Dine in only.
I want to dig more into these surveys that are showing people more unhappy at work now than they used to be. And my working theory on this, and again, it's a theory, I might be completely off base, is just that we're all generally a little bit or a lot bit in the aggregate unhappier now than we were 4, 5, 6, 7 years ago. And I think it's spilling into work, and I don't know that it's necessarily work that is inherently worse. I mean, if you look at like the last 40 to 50 years, I don't know that there's anything that you point to now where you're like, oh, like that's, part that's, worse than what's like. Why now, I guess, is my question, because the working world has been getting worse, in my opinion, pretty much since like 1952. I think that was probably like the peak, and maybe I've just watched too much Mad Men, but it feels like 1952 was like, hey, things were great. Like, we finally put the inflation in the post-World War II era behind us. We needed tons of people to get into work now. That brief post-World War II recession's over. Let's get to work. But then you look at really the last, 50 years, and it's, okay, my job's being offshored, my pension's being cut, my hours are increasing, my responsibility, this has been this buildup for a while now of what's been going on.
Could be economic insecurity. In fact, it probably is. And I think despite the really miraculous returns of stocks since the global financial crisis, when a lot of people thought we were in for a generational drought, much like 1930 to 1950. It took the stock market that long to recover, like a full generation. Some people thought that the groundwork was being laid for that. Stocks have bounced back, and so 401ks have generally done well, but not enough people have participated. Chuck, you've pointed out, and I poo-pooed, and I was wrong to do so. I've sort of changed my view on this since we last discussed it, but the per capita GDP stuff, the per head output that economists like to refer to as evidence of standard of living going up, it doesn't capture the variety of experience and the level of angst. And if you don't believe that, if I didn't believe it, just look at our political process, how fractured it is. And I'm not really qualified to comment on it. I'll just say that both parties take more extreme positions now than they did during the 1990s. It is harder to find consensus. And that's got to be due in part to economic stresses, part to cultural stresses. Both sides, I'm sure, are partly to blame, although you feel differently if you're on one side or the other. But there's objective evidence that the fissures between groups, if you like, have probably widened in the past 25 years. And that to me, again, is a manifestation of this stress.
Got a couple listener texts if you want to hear those.
Throw them at us.
Out of the 603, people became spoiled by working at home and making salary in their Patriots jammies. Another text out of the 860. My job has me doing almost 3 jobs, keeps asking for more and recognizes the workload is a lot, and then just keeps asking for more anyway. I've been here for 13 years. I've been working 110% for almost 2 years now. I am certainly unhappy with it.
And I think part of it also, the last couple of years in particular, if you're in a service-related job, people have really sucked the last couple of years. I mean, we've seen the videos of people just berating, whether it's on airplanes or at restaurants or wherever, Target, grocery store, wherever it might be. It's been a really tough time to be a service employee because it seems like people have no patience for when things go wrong in those jobs. And it's like, guys, we're all doing the best that we can, So I think we're all just a little burnt out, quite honestly. And we're all, kind of close to the end of our rope on some of this stuff. So I think that it spills over into the workplace. Again, I'm not saying that everyone's job is great because they're not. I guess I'm more making the point that a lot of jobs have been really bad forever. So why are they being reported as worse now is kind of where I am. Does that make sense?
Yeah, work has always been unpleasant. But, but if the rewards aren't proportional, if you don't have prospects of a better future or you can't see them clearly, which Americans have always had that. They've always held fast to the promise that your kids will do better than you did, just as you've hopefully done better than your parents did, or at least have a smoother road, if not materially richer. People, for the first time that they've been conducting these surveys anyway, since they've been conducting these surveys, don't believe that, and that's reflective of deep economic anxiety. And again, just look at our political process. If you look at, I'm not a historian, but you look at pre-Civil War politics. You had people beating each up on the floor of Congress. It actually wasn't much of a fight. I'm talking about Charlie Sumner getting beat up by a Southern Democrat.
Yeah.
Right. So politics got violent pre-Civil War, and then it opened into sectional violence, broadened into sectional violence. Politics has gotten violent again. You got a senator threatening to fight the head of the Teamsters in a Senate hearing room. You got the former House Speaker saying, hey, if I rabbit punch somebody, you'd know it. They'd be on the floor. This language is different. These acts are different than anything I'm accustomed to in my 51-year lifetime. Civility's breaking down. And when those norms break down, if you're upset about economic growth and you manifest it through violence, I got news for you. The worst thing for good economic growth is unstable institutions. So it's only going to make the problem worse if we continue to go down this road. It seems to me.
And, yeah, I think just to bring this full circle, as you said, and I'll also, go back to the Mad Men well for the second time in a segment, which is not great, but it is what it is. You talked about, look, work has always been bad. And I always make the quote, like, that's why they call it work. I mean, if it were just play, like, I'm going to play today. Like, that's what my 3-year-old does. Like, it's completely different. But to quote Mad Men, it's like, look, that's what the money is for. And the idea that, hey, if you work hard, you are going to be paid accordingly and treated with a baseline level of respect, you're not today. But my argument is, look, you haven't really been for the last 30 or 40 years. It's been not great over that time period. Again, I think like 1952 was like the peak. It's like, okay, I'm going to work at the same company for 30 years, get a pension, a gold watch, not have to worry about anything.
Yeah.
It's not really the reality today.
Tough,
and it probably wasn't back then either.
It's a tough comparison. You're right. That's the point I was just going to make. It's a tough comparison. Coming out of World War II, we were the only standing industrial power. We were half of the world's manufacturing. We were 80% of the world's, I've got those stats a little bit wrong, but not too far off, like 80% of the world's oil output. Our geographically, we were untouched, save a couple of, Japanese balloons that exploded somewhere over Oregon that nobody paid attention to. I mean, we really came out of that unscathed, and that set us up for 25 years, a full generation of rapid economic growth and expanding standards of living and material consumption. We just talked about the Framingham Mall. That epitomizes it, and there are examples in virtually every big major metro, area of something like that representing the economic prosperity of the time. So it's a really hard, when we look at economic growth today and say, geez, we're only growing at 2 to 3%. Yeah, that's because the 50s, 60s, and even 70s, which are much lamented, but in point of fact, they grew as fast almost as growth was in the 1980s, just without the inflation. So we're comparing ourselves to this golden era of incredible prosperity that largely came out of the sacrifices that the greatest generation made. Yeah. It's a tough standard.
Mark, have you ever read The Rise and Fall of American Growth by Robert Gordon?
Sure, yeah. I say, sure.
It talks about,
if you're in a comics,
it talks about this very thing, where it's this idea that especially if you were one of the baby boomers, and you're listening to us right now, like this is for you. You grew up during that time, and the norm for you was that post-war period. You grew up thinking this is what it's supposed to be. And the case that this book makes, and that I think is, in my opinion, kind of the crux of, again, the issues we're facing today. What if the period that you grew up with was the exception and not the norm? Because most of human history, it's not very pretty, actually. If we're being honest.
There was no per capita growth up until the Industrial Revolution, late 1700s in the UK, early 18 to mid-1800s here. It all went into population growth. Population grew, but per capita income, per head income didn't. People weren't better off. Some people, the poor, were worse off than their equivalents in medieval times in terms of diet, standards of living. I think Gordon, if not him, others have made this point. So in a way, Chuck, you're not going to want to hear this if you're listening, but in a way, we're spoiled by the experience of the early 20th century, like you said, things like electrification, indoor plumbing, air conditioning, electrifying factories. Those miracles can't happen twice, which is why there's so much excitement over AI. Maybe that'll lead to another industrial revolution.
And the other piece, I think, just if we're, again, kind of trying to pull it all together, if you look at the politics of kind of the 60s, 70s, 80s, 90s, even early 2000s, I don't know who had this theory originally. I wish I could credit it because it's not mine. I just know that. But the people who were politicians then, the vast majority of them served together during World War II and the Korean War. Most of them did. Like, you look at basically any senator or congressman from, like, 1955 through 2005, they probably served together, or at least knew people who served together, because everyone in those generations went in to serve because you had to. And there's a theory that, again, I don't know who had it originally, but part of the reason why you could maybe get things done and you got along a little better was because there was this mutual respect from, hey, we went through hell together, and I might not agree with you, but at least we're trying to work together because that's what we've always done.
Yeah.
And I got your back because I had it out there, and now I've got it here too. And you don't have that today. And maybe that was just that, again, kind of that snapshot, that 40, 50-year window that for a human lifetime, it's like, oh, this is how it always is. But in reality, maybe it's just that snapshot of history that isn't going to be repeated and that kind of stands out as, hey, that's as good as it can get because that generation went through as bad as it could get in order to get there.
Yeah, there's no sense of national purpose like there was. Maybe it's lack of a common enemy. We had the Soviet Union after the war. Don't have that. So what unifies us?
So just spitballing on this stuff. Let's take a quick break here. When we come back, we'll do a little bit of stack roulette. I'm going to talk about why Instagrammable offices are the dumbest thing ever.
Miss any of the show? You can catch up at your convenience by visiting financialexchangeshow.com and clicking the on-demand icon, where you'll find all of our interviews and full shows. This is your home for the latest business and financial news in New England and around the country. This is the Financial Exchange Radio Network. Securing your family's financial future is one of the most important elements of estate planning. Leaving assets to your children can be very beneficial. However, gifting these assets can pose major problems. If you gift your home to your kids and they suddenly decide to sell it, your gift could create massive capital gains tax problems. Cushing & Dolan are experts in elder law. Let them help with your legacy planning by calling 866-848-5699. Ask for their new guide called Making the Most of Gifting Assets. Whether you're deep into the planning process or just starting out, this guide contains the information you'll need to make the right decisions for your overall plan. Call today. 866-848-5699 and get this new guide, Making the Most of Gifting Assets. That's 866-848-5699 or request it online at legalexchangeshow.com. The proceeding was paid for and the views expressed are solely those of Cushing & Dolan. Cushing & Dolan and or Armstrong Advisory may contact you offering legal or investment services. Cushing & Dolan and Armstrong Advisory do not endorse each other and are not affiliated. Veterans Development Corporation is a proud partner of the DAV 5K Boston. Let's meet their CEO, Mark Vonner.
I enlisted in the Marine Corps when I was 18 years old, joining a long line of family members who also served our country. After my service, I connected with the VA healthcare systems, where I attended meetings with disabled veterans and learned for the first time about the DAV. I was so impressed with the work they do to help millions of veterans, including providing necessary services like transportation, education, and financial opportunities. Today, I stand a proud partner of the DAV and the 2023 DAV 5K. My company, Veterans Development Corporation, is a general contracting firm working with many disabled veterans, and I hope that by sharing my story, many other disabled veterans will be able to reach their goals once they conclude their service.
Veterans Development Corporation is proudly partnered with the Disabled American Veterans Department of Massachusetts and the presenting sponsor of the DAV 5K Boston. If you'd like to help our great American heroes by making a donation, visit DAV5K.Boston.
Hi, this is Susan Powers from the Armstrong Advisory Group. There are some important financial considerations to keep in mind as the end of the year approaches, so here are some crucial tips for you to think about. Our guide this month is called The Top Year-End Planning Tips, and in it, we'll walk you through key concepts like tax loss harvesting, family gifting, and properly calculating your required minimum distributions. All are important to your overall planning. Call our office today at 800-393-4001 and get your copy of this free guide that may help you finish 2023 with less concern about your financial strategy while setting you up for a positive start in 2024. Call 800-393-4001 and ask for your free guide today, or you can request it online from our website, armstrongadvisory.com.
The proceeding was paid for by Armstrong Advisory Group, a registered investment advisor. Nothing in the ad or in any Armstrong guide is specific financial, legal, or tax advice. Consult your own financial, tax, and estate planning advisors before making any investment decisions. Armstrong may contact you to offer investment advisory services. If you're looking for an incredible vacation filled with sun, fun, and no need for a passport, Look no further than the United States Virgin Islands. St. Croix, St. Thomas, and St. John were voted the #1 vacation destination to visit this December according to U.S. News and World Report. December is the start of the dry season in the islands, so you can expect perfect temperatures, beautiful beaches, a wide variety of water sports, world-class cuisine, and a vibrant nightlife. From the moment you arrive, you'll fall naturally in rhythm with the heartbeat of the islands. There's no money to exchange, and travel from New England could not be easier. Make your plans now before Old Man Winter comes calling. Head to visitusvi.com. Learn about all 3 islands and plan the ideal vacation for you and your family. America's Caribbean paradise is waiting for you. So head to visitusvi.com for more information and to reserve your trip today. That's visitusvi.com. Text us 617-362-1385 with your comments and questions about today's show. This is the Financial Exchange Radio Network.
This segment of the Financial Exchange is brought to you in part by the U.S. Virgin Islands Department of Tourism. Fall's in full swing. The cold weather's coming. Now's the perfect time to get a head start on your next vacation. The U.S. Virgin Islands have been named one of the top Caribbean destinations so far this year, according to Travel Pulse. Explore St. Croix, St. Thomas, or St. John and enjoy incredible beaches, world-class dining, and fall naturally in rhythm with the heartbeat of the islands. There's no passport required or money to exchange. Go to visitusvi.com and book your trip today. That's visitusvi.com.
Piece in the New York Times today. It's titled "The Envy Office Can Instagrammable Design Lure Young Workers Back," and it talks all about how, by painting offices all kinds of cool colors and putting cool furniture in there and all that stuff. Oh, gee, that's really going to make people want to come back to the office. And my view is, look, if you want me to have cool furniture and be comfortable and all that, let me work at home. If you want me to come into the office, make it something that's going to make me more productive as opposed to trying to get me back in with these gimmicks, because if it's just that you got a yoga studio there, I can go to the one down the street from my house.
Yeah, it would take more than that to get most people back, I think. Look, it isn't working, so it is.
If you want people in the office, it has to be because you think that's going to make people more productive for some reason.
Chuck, just tell them, if you ever wanted me to stop doing the part-time remote schedule that I have the luxury of having here, you would tell me that, and I would immediately change, because I value my relationship with you and the people here, and I value my job. It's that simple. Managers just need to be leaders and tell people what they really want from them. And the people will read between the lines. Well, geez, if I don't do this, I'm not going to get promoted or worse, so I will step up. Just tell people what you expect from them. Why half measures and skirting the issue, right?
Yes.
That said, I love working under flexible conditions, so please don't change that. But I lay this at the foot of managers who can't step up.
Totally. Tucker, you there?
Yeah.
I thought you were. Oh, okay.
That'll be
whatever.
You. That'll be you.
Okay, fine. I forgot. Whatever. Let's talk instead. I want to get to a couple other stories first. That was my bad, Tucker. Sorry.
It's all right.
Let's talk a little bit about what's going on in the auto market right now, because I don't know if anyone's been paying attention, but prices have actually been coming down for the first time in the last few years now. The last 6 to 8 months, we've started to see prices coming down a little bit, not just on things like EVs, which obviously had to come down to start to get price competitive, but also you're seeing it on used cars across the board here. And so I do think if you are someone who is in the market for a vehicle, either new or used, you got some options here as far as, what you can potentially do, and your money goes a little further than it did even, 6-8 months ago.
Yeah, and if the economy is softening, as it should after the breakneck growth pace we've seen over the past year, I would expect that to be reflected in demand for cars new and used, and for deals to get more reasonable and appealing. All else equal.
Yeah, and I think the piece that still is challenging for a lot of people trying to buy a car right now is if your credit is anything other than great. The interest rates for cars right now, especially used vehicles, I'm seeing a lot of people being quoted like mid-teens for used vehicles if your credit is sub 720, and that's paying a 15% interest rate on a depreciating asset. it stings, right? I mean, it's not ideal.
Yeah, that puts it out of reach for a lot of folks.
Taking a look at markets, we're in mixed territory at the moment. We got the Dow down 70 points. The S&P is down 3. We got the NASDAQ up 19. So, again, a mixed market so far today. 10-year U.S. Treasury now down 6 basis points to 4.42%. We got oil, West Texas Intermediate, down 33 cents a gallon, or rather a barrel, to 75.21. And we got gold up $5.90 an ounce to $2,008.90. We're going to take a break for the rest of the day, but I hope you all have a great rest of the first Monday back after Thanksgiving. We'll see you tomorrow on the Financial Exchange.